Hi everybody, and welcome to today's trustee presentation. My name is Tim Miller. I am Education Manager here at SuperGuardian, and joining me today is Emma McGee, one of our Associate Directors, and Emma's going to be helping me out to hopefully work through all of the questions that you have for us as part of today's presentation. Welcome, Emma.
Thank you. Hi everyone. I'm really excited to be involved in today's presentation, and I hope you get a lot from it.
Alrighty, well, let's jump straight into it. So what we're looking at today is a little bit of a review into the current situation or the current status of the superannuation industry, where we're at from 2020, and a little bit about what lies ahead. So as I said, myself and Emma are here to present to you. Do need to make sure you're aware of is that today's presentation is general in information. It's not, you please don't take everything as given and act on any of the advice provided. If you do need to seek professional advice on anything, then clearly you need to seek out the appropriate parties to obtain that advice. But what we are here to do is guide you from a trustee point of view to make the right decisions. So what we'll touch on is, I'll first go through a little bit of housekeeping for you. Then we'll do some legislative updates. So a lot of stuff that's come about recently that requires us to be on top of. And then I'll do a bit of a budget update. You'll notice that I've put budgets update there. Really what we're looking at here is the fact that we've had a coalition government for a few years now, and there's a number of unresolved budget issues as well, which haven't necessarily been removed off the radar. So I think it's important for us to address those matters as well from a trustee point of view. And then I just want to finish off on a compliance point of view and just sort of highlight what we can help with regards to SMSF administration, but also what your responsibilities are from a trustee point of view. So in very quick fire fashion, from today's session, we will be sending all attendees a link to the recording. So not only do you get to see us once live, then at your pleasure, you get to watch us whenever you choose in the future. But if there's anything that we make commentary on, that you can go back and have a rewatch of that. We'll also provide you with a bit of a summary. So we've given out a few trustee updates over the last 12 months. Well, what we'll do is a bit of a presentation update as a result of today, and send that through with the link of the recordings. As I suggested before, Q&As, we love them when it comes to trustee presentations. You can be anonymous, you don't have to put your name to it. Ultimately, what you've got on your screen there, what you've got as part of the Zoom presentation is a Q&A box. So if you've got any questions, please shoot them through to us. And Emma and I will be happy to answer them. What we've also done, because a lot of these announcements have occurred over the past 12 months, is we've actually prepared a few questions to bring up for you that have been asked to us by trustees over the previous 6 months. So some of them are relevant to the content today. So we've already got some prepared, just in case everyone's a little shy in the question state. And every question that we can't get to, we'll do our best to get to all the questions in the hour. But any questions that we don't get to, then we'll also put that in as part of a Q&A of the seminar, which we send through when we send through the link. So look, let's jump straight into it and move forward with the legislative update. So what I want to touch on as far as the legislation is concerned, and I think it's fair to say that whenever the conversation piece comes around COVID-19, there's a lot of disheartenment and all sorts of other things with regards to the impact that it's had on our personal lives, more so, and potentially our working lives as well. But there are also impact items for our self-managed superannuation fund and super in general. So some of those issues have been legislated, and it's important for us to understand what those issues are and what it means for our fund moving forward. That leads into another area, which is, to me, it's a significant area for self-managed superannuation fund, because of the nature of the member and trustee being related parties. And that is this concept of a non-arm's length expenses. So I will spend a few minutes talking about the impact of some changes that came in 2 years ago, but we're still sort of working our way through it with the regulator, with the tax office, to understand what it exactly means. And so it's a space that all SMSF trustees really need to be on top of, because the consequences of getting it wrong from a taxation point of view is certainly a space that we don't want to get into. So it's really a matter of trying to address those issues up front. And then we've got a bit of an increase in the contribution age, so I want to work through that as well. So let's start off by talking about the various COVID measures. And to me, there's probably three principal areas from a legislative point of view that COVID impacts us from our self-managed super fund scenario. The first one being the pension reduction. So this is not the first time we've seen this measure enacted by the government. We saw it back in 2007-8 or post 2007-8 when we had the global financial crisis. And ultimately, whilst most of us recognise COVID-19 as an issue where we've been looking at how do we provide supplementary income to people, how do we assist people who have lost their jobs, there's also the concept of capital preservation. And so where we found ourselves, particularly in April and May, was we saw the Australian stock market, for example, take a fairly steep dive. And that has an impact on our self-managed super funds and our capacity to pay income in the future. And so the government took action pretty much straight away, or in the concept of when they started to take action, to reduce the minimum pension obligations for both the 1920 year and also the 2021 financial year. Now that is set in legislation, so there's actually been an update to the minimum payment requirements that enforce this 50% reduction, which basically just gives us a greater scope to reduce our income requirements. Now, as I said, legislatively, it's there for 1920 and for 2021. And what's going to be really important for us to do in the admin space, but also in the trustee space, is to keep monitoring what the government do in this area, because when the global financial crisis hit, we actually had this reduced minimum pension for longer than 2 years. So it'll be something that we keep ourselves nice and on top of from a trustee point of view. So this applies to our account-based pensions, so our standard minimum pensions, 4%, 5%, those pensions it applies to, but also for those that have hit preservation age, so haven't yet retired but have started a transition to retirement pension. The minimum reduction also applies in that set of circumstances. There is no change to the maximum. So the 10% maximum that applies to a transition to retirement, that's still applicable. And I've highlighted there in red market-linked income streams, and red's not something to fear in this instance. Red is all about the fact that they are probably a less operative pension. Not as many people have these market-linked pensions. But the minimum for those has also been reduced. But certainly, if you've got a market-linked pension and you've got any questions about your market-linked pensions, then by all means ask us what the requirements are for them. So I know that we did have some questions in regards to the pension reduction. Emma, if you just wanted to let me know what that question was again.
Sure. So we've got a great question here. Does it matter if I continue to receive the same amount of pension as I was receiving before COVID changes?
Yeah, look, that's good. And I'll probably answer that in two ways. The first way is there's absolutely no issue with maintaining the existing pension level, because it's your pension. And so how much you draw down, particularly in the account-based pension space, how much you draw down is totally up to your own needs, right? So if you were previously withdrawing 5%, 6%, and you want to maintain that income, then there's absolutely no issue with doing that. And what I would say is for those that do choose to reduce their minimum, and therefore potentially if they've got a periodical payment or something in place, if they reduce that payment down by the 50%, then they need to recognise that potentially come 1 July 2021, they'll need to revisit their periodical payments to make sure they meet their minimum once it increases and goes back up. So absolutely no issue with maintaining the existing pension level. But if you do drop your pensions back and you're on some form of periodical payment, then there'll need to be that re-triggering of the standard pension in the future. And of course, from an administrative point of view, we'll be all over that, and we'll be communicating when we do our pension reviews with clients. We'll be reminding them of their obligations in that space. So the next measure was the early release measure of super. Now, you know, in the SMSF space, just to give you a little bit of a stat, I'm a bit of a stats man. I like to see what the ATO are releasing when it comes to self-managed superannuation funds. And recently they indicated that about 19,000 self-managed super funds had members that had applied for early release of their super. And so it was approximately 35,000 SMSF members that had applied for their super early release. Now, of course, we're not suggesting that people should or should not access their benefits early, but need to understand what the rules are. So we're currently sitting in the second tranche of early release. So those that applied before 30 June, that's all done and dusted, but people have got up until the 31st of December 2020 to make an application to the ATO, and all applications must go via the ATO if they wish to access their benefits. So just a reminder, to qualify, need to be either unemployed, or you need to be unemployed or eligible to receive one of the government income support. So of course, all this happened at the same time. And so we went from, I can't even remember what it was called previously, but job seeker is clearly now the new unemployment benefits. And so ultimately job seeker is the primary condition for meeting it from an unemployment point of view. But also there are some additional conditions that people can meet. And that is that after 1 January, they were made redundant. If their working hours were reduced by 20% or more. Now that's a really sort of contentious issue, is if your working hours were reduced, how do you actually prove that? And I guess the main way that people looked to prove that was via reduction in income. So it's very difficult to say that you maintain the same level of income, but your hours were reduced. And the tax office, I highlight down below the 1,200 audits that the ATO are performing. They've been able to do a data match of employee records to see that people are generating the same sort of income. So the ATO are all over it from a point of view of people making sort of improper or inappropriate declarations. And of course, for sole traders, then if the business was suspended or there was a reduction in turnover of 20% or more. And so if we're trying to apply in this second tranche, then we're still needing to reference our current turnover versus our turnover in the prior year. It's not about what our turnover was in April this year. So matching up whether we are still below that 20% on last year's turnover is incumbent for us to apply under the early release measure. As I said, it's self-assessment, so you're going through the ATO at the moment, but you need to be prepared to substantiate that, because the ATO have, as I said, undertaken at least 1,200 audits, largely around the early release of super and people undertaking pre-contribution strategies. And I think that led to, I certainly know I had a number of questions when I presented to this or on this matter before. I think we had a question in regards to that contribution issued. Emma, is that correct?
Yes, we did. So we had a client that satisfied the criteria and applied for access to super, and then she recontributed some of the benefits back to the fund, and she wondered if that would be an issue.
Yeah, look, it's a really good question, because what happens in the SMSF industry is legislation gets released and people make assessment of the legislation, and they try to make judgments for what you can and can't do. And I don't know that this was released anywhere but in the media. So it was in mainstream media that there was all of a sudden these articles talking about accessing money through early release and then putting it straight back in to provide tax deductions and other benefits via super. And of course, one thing about mainstream media is the ATO have access to it. And so they jumped on it really quickly and said that the early release condition is not a contribution strategy condition. It is about having financial hardship. It's about not being able to meet your immediate living expenses, and so accessing your super to help you get by. And so but the consequences of early release is a lot of people did access their super under genuine concerns, and then they found that potentially things like JobKeeper came along, and so they started receiving income from their employer, and there were other means that helped them get by. And so they didn't necessarily want to take their money in the first instance. and so they look to recontribute it. In that sort of situation, it all comes down to, and we were talking about this before, Emma, and you said the intention. And that's it. You know, what was your intention at the time? Well, if your intention was pure in what you needed to do, then there's no issue. It's more if you contrive a strategy to try and use the law to your advantage that you need to be mindful about it. And look, I wanted to just point out, I don't like to get all sort of doom and gloom with the conversation pieces around penalties and stuff from an SMSF trustee point of view, but I will highlight that because every year we get, again, statistics from the ATO that talk about the most common breaches that occur in the SMSF space. And still the #1 breach year in, year out, ever since the ATO have done these stats, is self-managed super fund trustees lending money or providing financial assistance to the members or relatives. And it could be the simple thing of using the SMSF bank account to pay a bill until your next pay comes by or whatever. But every time you do that, you breach the law, because the law says that the amount you can lend to a member or relative is zero, right? And zero is a pretty easy to understand number. But there's a couple of penalties, administrative penalties, that could be applied in the circumstances of accessing super illegally. Because super is, or the benefit payment is, what they call an operating standard. So all trustees are required to operate in accordance with a certain set of standards. And one of those standards is around how benefit payments are made and paid. And so if you breach the benefit standards or the operating standards, then there are 20 penalty units attached with that, which the ATO can impose. They don't have to. And often for a first offence, they don't impose penalties. They'll tell you to go out and receive some education, which is, again, a great way to engage with administrators, your advisors, your accountants with regards to helping through these. But 20 penalty units equates to $4,500 roughly dollars. Now that's imposed on each trustee, and it's not allowed to be paid from the superannuation fund. So there's a bit of a penalty for doing the wrong thing there. But if you provide financial assistance to members and relatives, well, that penalty jumps up from 20 units. So 20 units for doing the wrong operative thing, but for deliberately taking money out of super when you know you can't do it, then that penalty jumps up to 60 units, and you can look at a $13,000 penalty. So once the penalty is greater than the benefit, in this instance $10,000, then you certainly need to look twice as to whether or not, or think twice as to whether it's the right way to go. So yeah, it's one of those things. If you needed to take the money out, then there's certainly no problems with it. The other measure that I wanted to touch on with regards to COVID-19 is a little bit about the investment measures. Now, this is a presentation in itself when we start to talk about things like rent relief and limited recourse borrowing arrangements. And so I just wanted to really sort of touch on the key points that arise out of whether you are an investor from an SMSF point of view, particularly in property, and what that might actually mean, but also if you invest in other related entities. So self-managed super funds are entitled to invest in what they call in-house assets, which is an investment in a related company. It's an investment in a related trust. It includes loans to those related companies and those related trusts. And you can make those investments up to 5% of the total value of the entire super fund asset pool. Now the issue is that if you go over that 5%, then you have to put a plan in place to get that number back down. So you've basically got a 12-month operating space to get your in-house asset, your related party investments, back below 5%. Well, what the government recognised, or what the ATO recognised here more specifically, is that often those in-house asset investments don't move in valuation very much, so they're fairly stagnant. And so when we saw a drop off on the ASX, for example, and in some instances property valuations decreasing, well, what it meant was that those that were pretty close to the 5% limit all of a sudden found themselves at 30 June 2020 over that requirement. Now, what that means from a trustee point of view is you actually have to still put a plan in place. So when we're preparing the fund financials and working through preparing it for audit, if we notice that when we see that those investments are over the 5%, we can at least have a conversation with you about how to put the necessary supporting documentation in place for audit purposes. But the beauty is a bad choice of word here because we're talking about investments dropping, but the beauty of the COVID relief is that the ATO have said you don't have to follow through on that plan if we see a market correction. So if the market starts to improve over the next 12 months and therefore your in-house assets drop back below 5%, then you don't have to enact the sale of those assets by 30 June 2021. So that's an area that we'll be certainly monitoring and continuing to discuss with trustees who are directly impacted. The other area was rent relief. Now, rent relief clearly became a fairly significant subject or topic point, not just for self-managed super, but for the entire Australian community with regards to people working from home, businesses closing down, certain industries shutting down, and therefore the commercial viability of maintaining tenants inside properties and tenants' capacity to make payments. And so the government acted relatively quickly, I felt, with regards to commercial properties, and they provided a code of conduct, so a commercial property or commercial rent code of conduct, which provided for those that were eligible for JobKeeper. So it was kind of defined towards those who had experienced a 30% turnover decline, but those that were entitled to JobKeeper could provide rent relief or could apply for rent relief with regards to their commercial rents. So it was kind of a handshake agreement as such between landlords and tenants that said, okay, well, you're financially suffering through the COVID-19 or the impacts of COVID-19, and it had to be through the impacts of COVID-19. So the turnover had to be as a result of that. And then you could provide rent relief either via a waiver or a deferral of the rent. And so what the ATO said was that this does apply to self-managed superannuation funds. If there is genuine reduction in turnover, then you can provide yourself as a related tenant with that rental relief. Now, the reason it was such a relevant issue for the tax office and self-managed super is because the ATO are aware that many of us rent commercial properties from our self-managed superannuation funds. And as such, if we reduced the rent, then it would be considered that income would no longer be commercial, and that would have taxation consequences. So the ATO did say rent relief could be provided, and it's certainly valuable to follow the government's guidelines on the commercial rent relief. But what the ATO have indicated, and they've provided what's called a legislative instrument, and it says that rent relief, and particularly the deferral, because the deferral just pushes the liability further down the track. So instead of having to pay now, we still have to pay any deferred amount later. But in essence, that is financial accommodation. And as financial accommodation, it is considered a loan to a related party. So the ATO have this instrument to say that will not be a loan to a related party for in-house asset rules up to 30th of June 2021. Now, I always sort of take note when there's a due date put on something, because it means that we need to explore this once we get towards June 2021 and have a recognition of what it means for those that are still carrying a deferred rent liability inside or asset inside their SMSF. So this rent relief has provided that for us, and that is certainly a benefit for us to be mindful of, but one that we have to continue to watch this space. And of course, the extension of that often for a lot of these properties is that people have entered into borrowing arrangements to buy them. And we know that the Australian Banking Association has recommended or provided that a number of the large banks provide some loan relief to borrowers. And so again, the ATO have extended that to self-managed super fund to say, if you've got a related party loan, you can have some form of deferral put into that. But of course, the related party loans are under such sort of strict conditions that it's going to have an impact later, because you still have to make your repayments within a restrictive term. And so LRBAs, limited recourse borrowing arrangements with related parties, is certainly something that we need to make sure are monitored on an ongoing basis to make sure that that funds don't get themselves into a liquidity issue with the repayment. So again, that's an area that we ask people to monitor relatively quickly. Now, we actually receive lots of questions and have had lots of questions in relation to all these rent relief issues, but I did want to identify one that we had, and then what we'll do is a number of the other questions that I've addressed over the last 6 months we'll incorporate into the materials that we send out afterwards. But what was that other question that we had?
Yeah, so we had a client that provided themselves with a rent reduction because they experienced a drop in turnover, and they wanted to know what documentation they needed to provide for end of year processing.
Yeah, okay, so that's a good administrative question, because this is how the events happened, right? COVID-19, government made all these sorts of announcements, people started to think through all the issues, and they said, well, I can't pay the rent, I've got no money coming in, and so they either stopped or started to pay reduced amount, and that's the natural way things occur.
Yeah.
But then we have to be able to satisfy the fund auditor. So because we've got an audit regime that we have to go through, we need to make sure that the trustees have done the right thing or have attempted to do the right thing here. So what the ATO have ultimately provided is, when we're looking at providing rent relief, and this is also links into the code of conduct and the guidelines from the government, we need to see a request, right? So the first thing that we need to see, or they need to provide us, the request from the tenant, right, that relief is necessary. Now, this is, you're all self-managed super fund trustees, so you all know the awkwardness of being an SMSF trustee, and that if you want a pension or if you want a benefit, you have to write to yourself and ask yourself for permission to have that, and then you need to approve that. So you then need to write back to yourself in a different capacity and say, yes, it's okay for you to start a pension. Well, the same thing applies effectively with rent relief, and that is that as the tenant, you are applying to the landlord. And you're saying, okay, here's the circumstances. We have seen a decline in turnover as a result of COVID-19, right? And you look, for the purposes of the fund auditor, we're not suggesting that all sorts of financial statements and all those sorts of things need to be provided. It's more about having that material available in the event that it's ever questioned as to why that rent relief was provided. Okay, because it's an expectation that most commercial properties will have seen, or most tenants would have seen, some form of decline. And so it's about having that initial request. It's then about the trustee review of the situation and the circumstances, and then finally the trustee acknowledgement. So the trustee, as the landlord, going back to the tenant and providing that information. Now, what that actually looks like, you know, there's commentary from the ATO that has said ultimately they would love to see amendments, addendums to the lease, which provide that information, but it's not mandated. So again, that's not our area of expertise. We would be suggesting that if you've had a lease drawn up, and you should have had a lease drawn up, that you at least review that lease document to determine what it dictates you need to do, but at the very least provide the tenant request, the landlord review, and then the trustee advice as to the relief provided, but also specifically the timeframes. So at what point in time are you going to review this? And clearly, as we understand, with self-managed super funds being a national issue, that a lot more clients in Victoria will have longer term issues in, say, South Australia or Western Australia, where, and whilst Western Australia's borders haven't been open, it's been a lot more business as usual. And so, you know, we need to be mindful of that when dealing with clients, as do SMSF auditors. And so if they're asking questions, it's really because they want to have the satisfaction that they don't need to report the issue. So the ATO have changed the tax return for 19, 20 and 21 years to make sure that these things aren't automatic breaches, but rather that the auditors are only identifying really clear problems that jump out at them from the SMSF space. So yeah, look, it's a really good question, but we are here to help people that need any sort of information, and that I think leads into the non-arm's length income expenses. So from a legislative update point of view, this law came in from the 1st of July 2018, but what it actually, it's not meaning to laugh at the issue, but I laugh at the length of how this issue has gone on for, because it's been announced, it's been in the pipeline for probably 4 to 5 years, and then the law just changed. But if you actually read through the history of the changes, it was all about a concept where people were lending money to their super fund to borrow, so limited recourse borrowing arrangements, and they were lending at zero interest, right? So this whole concept of non-arm's length expense has been born out of people, in effect, contributing money to super, but not calling it a contribution, rather treating it as a sort of a loan, where the terms was, here's the money, you don't need to pay us any interest and you can repay us when you sell the asset, which is not really how loans work. That's not how the banks operate. They like to generate their revenue along the way as well. And so that's kind of where this whole non-arm's length expense issue started. And it's worked its way through to a point in a number of legislative iterations where what we know is that if you are generating income that's more than expected, right, if you're dealing at arm's length, so if you're dealing with a third party, an unrelated party, then the terms of that relationship are generally going to be commercial. You can't walk into a shop and suggest what you'd like to pay for something, right? The shop have a tag on it and you pay that. That's commerciality, right? So if you're in the SMSF space and you're renting, again, talking about commercial property, you're renting to a related party, then that party can't pay you higher rent because it suits you to put more money into the superannuation fund, because you're considered to be bypassing the contribution caps and those sorts of rules. And so non-arm's length income was a way to introduce rules around income not being siphoned in to the superannuation environment to get taxation benefits. So you still need to deal commercially. But what they felt was that, you know, you could have entered into a limited recourse borrowing arrangement. There could have been lower than commercial interest rates charged, but the rental income was all legitimate. And so what they were saying is, well, it's not just an income issue. Is the income being overinflated because there are lower than normal expenses incurred? And so what's come into effect from 1 July 2018 is that if the fund incurs a loss or an outgoing expenditure that's less than arm's length, and that includes nil. So if there is no outgoings or expenditure, then we've got a non-arm's length expense, and that will impact the income of the fund associated with that specific asset and result in the income from that asset being taxed at 45%. So ultimately what it's saying is if you're providing a financial favour to a related party, then you are paying a higher rate of tax. Now, I've given a couple of examples there: labour costs, interest expenses, administrative expenses. And before I get to a question that I know that Emma's got there, I remember one of the very first questions I got when a lot of these changes came in was from a client who deals with the installation of, I'm going to say kitchens. I can't remember which part of the property it was, but it was renovations, improvements, and all those sorts of issues. And they were paying market retail prices for all of the materials. So the super fund was doing the right thing in that regard. But because the client actually had the skill set and often used to do the installation of kitchens and other things, they asked whether or not they could pay retail for the materials, but then not charge any labour. And it's kind of before 2018, that's what people did, you know, because it provided retirement benefits. You weren't diminishing the value of the fund assets. But these new rules basically suggest, no, you've got to make sure that if you are undertaking any sort of service outside of your role as a trustee, then you need to be paying commercial rates at it. But I know that we did have a pretty general question, I think, on that one recently, Emma.
Yeah, so someone wanted to know if there was a guide as to what was allowable.
Yeah. Is there a guide to what? That's a great question. I don't have a great answer. I have what I have is a "we hope so" answer to that one. So the industry has spent a bit of time with consulting with the regulators, because, you know, there's a concept of, when we're talking about these expenses, is what is going too far, right? So if you've got residential property, if you've got an investment property inside your self-managed superannuation fund, and you go and mow the lawns, right? Well, do you have to, like, should you be engaging with Jim's mowing to do that, or, you know, can you mow the lawns yourself? Right now, are you a professional lawn mower? You know, these are
Certainly not.
You're certainly not. So these are the sorts of questions that you know, spring straight to mind when you're dealing in this space. And so we want to get some sort of recognition from the regulator as to what you can and can't do. And so where they've started is, they said, if you're undertaking your responsibilities as trustee, well, you can't charge for your trustee responsibilities. And so I would look at the concept of, you know, if you've got investment property and you go in there and do the vacuuming or do whatever just to keep the cost down, then that sort of thing is pretty minimalistic and doesn't really impact the rental income, the cost or anything like that. But if you are doing maintenance, if you're doing paintings, if you're doing significant improvements to the property, and you want to engage yourself in a professional manner, then you need to certainly be mindful of it. Where we do have a guide is for those that prepare their own financial accounts, right? So that obviously doesn't apply to anyone online here, because you're engaging with us to do your fund administration, and so you are paying commercial administration. But if I start using all of the materials and all the equipment at SuperGuardian to lodge my self-managed super fund return, right, and they don't charge me for the use of that, then the ATO is saying that's non-arm's length. Like, I'm actually getting a benefit out of that, and that's what they're trying to move away from. And similarly, to move it away from administration, if you're a property manager or something, and all of a sudden you're providing those property management services cheaper than what you would commercially. And I mean, I can give lots of examples, but another one is an investment manager. You know, if you're an investment manager and you provide reduced brokerage to your fund, or no, you don't charge for it, then those sorts of areas could be caught up with it. So it's been ongoing. So even though it's got a 2 years ago start date, we still don't have the final position from the ATO on a lot of those issues. But what the main point for me to get across today is that if you are dealing with yourself, particularly if you've got any property investments or non-standard investments, that when you're dealing with yourself or a related entity, that everything is done commercially. And that's really the critical message that we get across out of that. So, and I'm probably spending a lot more time on these legislative changes, because they're the things that we have to be mindful of right now. And so the things that I'll be finishing the presentation off with, a little bit more speculative, a little bit more about the future. And so, you know, we don't need to dig as deep, because we can't dig as deep. That'll be the subject of the future presentations that we provide for you. So one of the changes that was announced, so I mentioned before when I talked about budgets and multiple budgets and announcements, the government did make an announcement in last year's budget that they intended to increase the contribution age limit from 65 to 67. Now, the alignment of that announcement was to fit in nicely with the idea that the age pension age is increasing over the next few years from 65 up to 67. And so from a contribution age point of view, it meant that you would have the capacity prior to your 67th birthday to make contributions without meeting the work test. So as it stood last year, once you hit 65, you had to meet the work test, which was 40 hours in 30 consecutive days, right, of gainful employment. Now, again, I could spend a lot of time on all the questions I've had about gainful employment over the years, particularly for people over the age, so people over the age of 67 in this instance. And just a quick tip on that, looking after the grandkids, mowing the lawns, as I talked about before, really doing anything that would otherwise be considered your personal obligations or chores would not be gainful employment. Okay, so it really, I suspect or suggest in many instances that it is a genuine employment arrangement. You can see that separation of duties there. But you know, there's case law and a lot of other things that go into it. But what it means is that from 1 July this year, our 65-year-olds and 66-year-olds, they don't have to meet a work test, right? So they're still subject to all of the normal contribution cap rules. And I'm going to touch on a few little changes there in a moment. But it's not until their 67th birthday or contributions after that time that they have to contemplate meeting that 40-hour requirement. Okay, so that was, to me, a fairly significant change for our industry, because for years, both the SMSF industry and other parties have talked about why is there a contribution age limit. And whilst we have potentially asked for it to be totally abolished before, you know, at least there's been some grounds given. So it's one of those sort of win areas, I think, particularly for those who, for whatever their circumstances, have the capacity to make contributions after their 65th birthday. And that ties in with the second contribution measure that also took effect from 1 July 2020, and that is that we've got the capacity to make spouse contributions up until the spouse's 75th birthday. So that previously used to cut out at age 70. So you were better, and it was a legislative anomaly because it was always about the concept of who is actually making the contribution. And once you were over 65, which is now 67, it was all about meeting the work test. So the concept that spouse contributions cut out at age 70, whereas personal contributions cut out at age 75, it was a legislative anomaly because largely in a lot of instances, the money was coming from the same bank account. And so it's just, okay, well, you tell me the contributions from me or from you to determine where it's from. So now the legislation's been rewritten to talk just about member contributions. So a member contribution can be received. The source is not so relevant up until 75. Now, what 75 actually means is it means that the contribution must be made within 28 days following the month in which somebody turns 75. So if you want to be a little bit sort of adventurous with that, if you're born on the first of a month, then you've got basically the full month and 28 days or 27 days to be safe to make that contribution. But if you're born on the 31st of a month, then you've got a lot less time to make that contribution. So just be mindful of those sorts of issues as you go along. So that's probably the most significant change with regards to contributions. And I know that we've just received a question about the contributions.
Yep, we did. So someone wants to know, does this change have any implications on when we can access super or other contribution rules, such as the downsizer contributions? Yeah,
look, that's good. I mean, in my job, I get to do a lot of presentations and about the contribution rules and other things, and probably the fear factor of 67. If there's a fear factor around the rules of superannuation, it is that if the pension age is increasing to 67, which it is, and the contribution age is increasing to 67, which it has, does that mean the access age to access superannuation benefits will go up from 65 to 67, or more importantly, the retirement age, will it jump from 60 from a preservation point of view to 67? Look, I can't alleviate people's future fears. All we can say is that as it currently stands, there is no indication that the condition of release age will move from 65 to 67. And we can only rely on what governments have previously said about preservation, and that was that they have no intention of changing preservation age from 60 to 67. And they made that announcement when they increased the pension age. So if we can take governments on face value, that's a big if, but if we can take them on face value, then the expectation is that we shouldn't see a change there. But of course, superannuation is an ever-evolving vehicle. And so it's one of those things that certainly from a consultation or a consultative point of view, there would be a great amount of backlash if that age moved from 65 to 67. The downsizer one is an interesting one because that's obviously a new measure. And that was almost a way of saying, right, well, once you can no longer contribute under the rules, which was the 65 rules, here is a capacity for you to contribute, right? And that is via the sell down of your residential property and contributing the proceeds to super. But again, as it stands, there's been no real connection between this age increase to 67 and the downsizer. So right now, you just operate in the environment that you're given, and hope that if changes occur, that they are prospective changes rather than retrospective changes, and that you have some time to plan. And generally, with a lot of superannuation measures, that's how they operate, and so they're not too significant in that regard. So yeah, look, I think the contribution space, especially, Emma, is one of those ones that we need to remain on top of. And I know I did a presentation to our advisor network just the other day on this space, and said how much it's changed just in the last 4 years. There's been a change on the 1st of July every year in relation to contributions. And so it's really important for SMSF trustees to be on top of what those changes mean, just so they make the most of their own circumstances to be able to contribute. So we'll, as I said, we keep our eye on those sorts of things for them. So from the budget announcements from both this year and prior years, so what I want to touch on quickly, and this is a bit of an extension on that, that last announcement about age 67, and that is that for those that know how the contribution measures work, is that if you make a contribution currently before your 65th birthday, you can bring forward up to a future 2 years worth of contributions into the superannuation fund. So as a 64-year-old, you could conceivably contribute or trigger $300,000 contribution rather than a $100,000. And it's subject to your total superannuation balance. So how much did you have in the superannuation environment at the previous 30 June? And so the government have actually legislated this announcement to increase the bring forward provisions to 67 as well. So there will be alignment that suggests that if somebody is 66 on the 1st of July, that they can make a contribution for the next 3 years at that time or during that financial year, subject to the total superannuation balance rule. So in this instance, what it actually means is that for somebody who now currently has less than 1.4 million, right, and is 64 on the 1st of July, right, they can contribute $300,000. If this legislation passes, right, then somebody who was 66 on the 1st of July this year would be able to make a $300,000 contribution. But I say to be mindful because it's not law yet. And so it's one of those areas that that we need to think through. And I think we just had a question come through about that on the contribution measures.
Yep, so someone would like to know if there is anything else impacting this legislation.
Yeah, all right, so is there anything else impacting this legislation? Yeah, so in political terms, they call it the Pauline Hanson One Nation Party, and what I'm referring to there is in the Senate, which is where this legislation currently sits, is Pauline Hanson's party has made a number of suggested amendments. So the law is sitting in the Senate, and the government and the opposition have said that they will give support to this measure. But as a result of COVID-19, as a result of market drop downs, and as a result of even the early release of super rules, there has been a significant number of amendments proposed, right? And so whether those measures have any widespread support from the other parties is a little bit unknown, because the measures were announced and then Parliament was dissolved, right? Or not dissolved, that's not the appropriate term, but Parliament stopped sitting, and then we had the federal election. So the Senate won't sit again until November. So we expect these measures to go through unchanged, and so people will be able to make or utilise the bring forward provisions in this year. But there's always the chance that the amendments will slow it up, right, or will result in some changes. And of course, that's where we will get on the front foot and communicate with everybody about it. The other thing that was raised, so that I said, Pauline Hanson created probably about 5 or 6 different amendments to it, was that Labor did ask, as part of the legislative process, that the government give a guarantee that they weren't going to freeze the super guarantee increase that's meant to occur to 10% from 1 July next year. Now, the government argued that that shouldn't be part of this legislative process, but it was interesting to note in the federal budget, where there wasn't much else on super, that there was no announcement to freeze the super guarantee. So the expectation is that super guarantee will increase to 10% from 1 July, and that could very well be an aid to the government to get this bring forward measure introduced. So again, that's a significant measure for us to consider. The other one is the 6-member self-managed superannuation fund. So look, this is an intriguing measure. A lot will suggest that it was introduced to counteract the Labor Party's budget announcement or previous election announcement about franking credits, but it had been in the pipeline prior to that, and it was just used as an offset measure. But prior to the federal election, the government introduced a change to increase the SMSF membership from 4 to 6. That was thrown out or removed from legislation just prior to the budget to get some other measures passed. But then the government put it in their first federal budget and said, we are going to revisit this increase of self-managed super funds to 6. So it was introduced into the Senate, and it was done that was done in September this year. It was done deliberately so it could be referred off to a Senate Select Committee. So the whole concept of 6-member super funds, there is now law about it. If the law is passed, then it will be in effect from the start of the quarter following royal assent. So if, for example, it was passed in February, then we would see that come into effect from the 1st of April. So we'll have to wait and see and communicate back there. But probably the big impact item for self-managed super fund members looking at potentially increasing their membership is that one of the identifiers from the legislation is this requirement from a signing obligations point of view. So where we talk about the specifics of the fund accounting, if you've got more than 2 SMSF trustees, then at least 50% of the trustees or directors will have to sign. So, you know, there are other issues, and I know that we've had, probably going back 18 months, whatever, we've had questions from clients in regards to this space.
Yeah, so we've had a couple of clients just ask what they need to know or what they need to organise from an admin perspective if this goes through.
Yeah, okay. So taking the signing bit out of it, because that's an annual obligation. But if you increase your membership, then obviously if you've got individual trustees, you're going to need to do a trustee amendment. And so it's important to understand how the deed would operate there with regards to adding those trustees. You'll also then have to change the asset title. So that can obviously be complex in the sense that, say, the share registries or others might not allow that many names or characters to be incorporated. So you've got those little admin issues, and of course notifying the tax office. If you've got a what do we call it, a corporate trustee, then in that instance, what the situation would be is that you would have a situation where you don't need to do anything as far as the assets are concerned with a corporate trustee, because you've already got the single set of, or the name, the proprietary limited name to oversee the assets, but you'll need to update ASIC. Yep. So you'll need to notify the change of directors, and you'll need to notify the ATO of the increased number of funds. Did we have another question in regards to that?
So someone asked if deeds need updating, which we've just covered.
Yeah, and so the deeds, as a rule, if you've got a corporate trustee, I guess where I'd make a blanket comment is that if you've got a corporate trustee, you might not need to amend the rest of the deed, right? You might need to do an appointment of new trustees with the individual trustees. What you may have to do, and this is the uncertainty, is some deeds were referenced when this announcement was first made, and people referenced it and said that your deed may specify how many members you can have in your self-managed superannuation fund. And so if you've got a deed that specifies the number of membership, then you might need to amend the deed. Most deeds, I know the deeds that we use just talk about the definition of a self-managed superannuation fund. But again, I think because our deed providers will go through that and they will make any reference at that time. So if we feel that a deed amendment is necessary, then we would be communicating that message to the funds that it's relevant to. I mean, deed amendments are one of those areas that you try not to impose them on people if they don't necessarily need to have them. So yeah, look, that's the 6-member super fund. A couple of deferred measures that I wanted to touch on, and there's a bit of irony in this for me, a little bit of irony, because we talk about the first one being red tape reduction, and then the second measure is about red tape introductions. So what we would look at there is a situation where, from a red tape reduction point of view, from the 1st of July 2021, what they're looking at doing is introducing changes to the actuarial certificate. So right now, if you've got a pension and you've got in total superannuation across all of your superannuation funds more than $1.6 million, but only a pension inside your self-managed fund, you need to get an actuarial certificate. The proposed changes are that requirement will be removed. So we will see a little bit of a change over time with regards to our actuarial retirements. So they're really trying to cut down on how much admin funds need to undertake. The second one, and this is where I guess I talk about a little bit of irony, is that one says, let's take away your responsibilities, let's take away some of the things that we have to do here from an SMSF trustee point of view. The next one is the introduction of what they call a retirement income covenant. Now, we are a long, long way away from this occurring, and I'm not talking about the target date of 1 July 2022, but what the government want to do, and they have to basically go through a consultation period, and then they have to go through a legislative period where they want to introduce a covenant to the law, which requires all trustees, including SMSF trustees, to formulate, review, and give effect to a retirement income strategy for the members to meet their retirement income objectives. So right now, as SMSF trustees, you have to give consideration to the diversity and all those sorts of other requirements under the investment strategy covenants. You also have to give consideration to the insurance needs of the members under the insurance covenant. This will be a new covenant built into the law where all self-managed super fund trustees and other fund trustees have to at least prepare and identify what the retirement income objectives are of the members, right? So the industry is looking at enhancements of retirement income products and other things as they go along. And so what we will see there is if there's an advancement in the Australian retirement income product market, then self-managed super funds would avail themselves to those products. So it's a little bit of a wait and see, but this is similarly to the insurance one. This is something that all self-managed super fund trustees will have to engage in. So it will be as relevant as having an investment strategy, and it will be more than just having a few dot points on a page. And so it's something that the industry will have to work through closely, but I want to raise that with you as a possibility. There was just a comment added before in regards to the trustees in reference to Top Docs, which is one of our deed providers, and a reference to the 4-member funds. As I said, I suspect that what will happen is that the legal powers behind a lot of these deeds will review and determine whether it's a necessity to amend. And so we'll wait and see, because the legislation itself is far from through. And if you've got a fund that's not going to have more than 6 members, well, the impact of stating that you're not going to have more than 4 is a little less relevant to your fund set of circumstances. And so I'm always an advocate of not enforcing change for the sake of change in that regard. And look, just to finish off with, there's a couple of other considerations from the federal budget, or more to the point, not from the federal budget, that I just wanted to identify that we as administrators and accredited educators, so we work very closely with the SMSF Association in the education space, and a representative with a number of other sort of key industry bodies, where we sit in panels of people that have had a little bit to do with some of these issues to try and get enhancements to the super industry. So there's a couple of areas, and we could have made a longer list, but I just wanted to touch on people with pre-2007 sort of legacy defined benefit pensions, the definition of the Australian superannuation fund, which is very skewed in favour of non-self-managed super funds, where if people are overseas, it can be problematic for the definition. And then the government's review of various conditions of release. So these are all measures that are on a very large government radar, but they don't necessarily take priority right now. But as an industry, we will continue, and as a representative of the industry, will continue to push for these measures, because that concept of red tape reduction is clearly fairly significant to us, and where you've got issues that create problems for self-managed super funds, then we want to go some way towards alleviating those problems and making life better for people. So look, I wanted to finish off with a quick comment on SMSF compliance, and this is really a little bit about the way of the rub of the land as far as how the regulators and that work. But self-managed super funds trustees, they make mistakes. Let's be clear on that. I mean, I'm a trustee of my own self-managed super fund. I've been over time, and I amended from individual to corporate trustees. We all make little mistakes with the timing of things, or transactions where money should or shouldn't come out of the super fund. But you've basically got 2 ways to go, right? And really what I want you to identify is the green side of the screen here. And that is that if something occurs, it doesn't matter how small it is, identify it. Now, we can be part of that identification process, because often if you've made a mistake as a trustee, you might not be able to identify it. So we see ourselves as playing a part there in helping you identify it. Then it's important to disclose that, right? To raise that to the attention, and that in all instances really should be to our attention, but also based on those conversations to the attention of the ATO. The ATO are an educator as much as they are a compliance organisation, and so they want to make sure that if you take the right action, that your fund can just move on. Okay, what they don't want is they don't want people hiding their issues and hoping for the best. Okay, because if you hide and hope, then the likelihood of it being found out from an audit point of view is more problematic, and the likelihood of penalties is certainly far greater. The ATO have a great voluntary disclosure situation or arrangement where you just send them an email and outline your set of circumstances. Then they can address it with you, and if you identify what you're going to do to fix it, then they can help solve your problems. But they'd much rather have that communication. I know for 3 of our clients in the last 2 to 3 months, I have suggested to them, why don't we speak to the ATO about this matter? And in all of those circumstances, a couple of them are still ongoing, but in those other circumstances where they have made a proposal to the ATO of how to fix something, the ATO have accepted it and said, let's move on. So we want to encourage that from a client point of view. So yeah, early engagement's preferential. The ATO still prefer things to be fixed, and therefore you keep your benefits, and us being there to help you along the way. So look, that brings us to the end of the formalities with regards to the presentation. From an updating point of view moving forward, we are hoping to continue to run our trustee seminars. I certainly am a very big advocate for it. I'd love very much to see you all face to face. So I think we're going to look at the idea or the possibility in 2021 for at least one of our trustee presentations to be a face-to-face offering, but of course we'll always go with what the requirements are at the moment. We're providing regular trustee updates and news, so we really want to, like we did with the budget, like we did with COVID-19, have that information ready and available for you. Updating and creating more fact sheets on the fly, so our website content is continually evolving, and one of those evolutionary pieces which is in progress at the moment is a bit of a self-paced trustee education course. So again, the capacity for you to go in and identify a single subject matter and take some learnings away from that. So the industry doesn't exist without trustees, obviously, and clearly for a compliant industry, we need trustees to understand what their obligations are, and so we, as much as we can help in that space, we will help. So look, what we'll do, we'll give you an opportunity if anybody's got any questions. I was waiting for the bombardment of questions to come through from the presentation. I mean, the email and the phone lines are always open, and you can always send them through after we send through the fact sheet or the session review document tomorrow. When we send that through, we'll also send through a little survey, because these sorts of events, the opportunity for us to present to you, are only made possible if we know a little bit about what you want to receive as well, and what you want to receive information on. I reiterate that we're not here to provide advice, so we'll always provide that compliance support and factual information. But we won't tell somebody that they should make contributions or they should start pensions or any of those things, or even add members to the fund, any of those things that are specific to your set of circumstances. Then obviously we will not engage in that sort of situation. But very keen to get your feedback, even on the timing of these seminars and how we can enhance the experience for you. So thank you very much for joining. Emma, thank you very much for helping me out.
Thank you.
And if we haven't got any questions coming through, we will bring that to an end. So thank you very much, and we look forward to speaking to you all next time.